Hello Sector Watchers, welcome to the show. This is the 92nd episode of Sector Spotlight for Tuesday the 17th of August, recording it on Monday the 16th. My name is Julius de Kempenaer and I am, as usual, presenting the show today from Amsterdam in the Netherlands. As the regulars know, I love the interaction and your comments and feedback, so please use any of the handles on the screen for anything that you would like to share with me. For today, I am planning to do a quick overview of rotations for asset classes and then spend a little bit more time on the sectors and dive into the industries, the industry groups that make up the sectors. I actually wrote an article about that subject for last weekend's ChartWatchers Newsletter. I got a ton of feedback on how much you appreciated that article. So thank you for that. But because operating the platform is really interactive, I think I'm going to, or I'm planning to take the content of that article and show it to you live on the screen as I work with the StockCharts platform, as I believe it'll give you a much better idea, or if you've already read the article, a better insight on how you can use it and how I use the various tools and interact with them. Nevertheless, let's start with an overview of asset classes, then go to sectors, and then go to the whole top-down thing. When we look at the rotation for asset classes over the last 5 trading days, and for this particular set it means that it's updated through last Friday. Another good week for stocks. As you can see, although all the performances were very close to home, the index, the balanced index, gained 40 basis points and stocks gained 50 basis points. By default, that means that government bonds are underperforming slightly. In this case, they picked up 10 basis points. If you look at the rotation, you see that stocks are very lonely inside the leading quadrant. A lot of all that stuff is in the red, so it's or in the yellow, so it's inside lagging. Real estate is moving towards lagging, and the only other asset class, if you really want to call it an asset class, is the US dollar. That's actually picking up versus VBINX. So a clear good week, clear winner week for the stock market, and all that bond-related, fixed income-related asset classes, as well as commodities, actually underperforming the balanced index. The Bloomberg version in line with VBINX. Now, if we put that into perspective with the longer-term picture, then we see that that universe is actually split. It's split in improving and weakening. So it's a universe in transition, I think I should say. Because there's nothing in leading, there's nothing in lagging. So you know the whole thing is shifting. Now the clearest rotations are for the commodity ETFs, GSG and DJP. They are very strong. We've talked about it before. They're in a long-term turnaround, long-term rotation, I believe. And what we see now, I think, is a first serious downturn for these ETFs, for that asset class, after a long run up. So we're going to monitor that, but for the time being, there's still a very strong asset class inside this universe. Same goes for real estate. Real estate did a fantastic job, and what you see here is that V and Q is now rotating from leading into weakening. And a similar thing is happening on the daily. So for real estate, both tails are in sync. They're both inside weakening and both pointing towards the lagging quadrant, which suggests that we can see a period of underperformance for real estate in coming days, weeks. Remember that the weekly RRG still has V and Q as the strongest asset classes, going through a negative rotation right now. It doesn't mean that it is immediately a very weak asset class. Actually, it is a strong asset class that's going through a correction. And the best thing to do right now probably is see if we can pick up or find a good entry point to profit from a new rotation back up, a new uptick in that relative performance versus VBINX. Now, if we look at stocks versus bonds, then stocks are very short tail, and as you know, short tails are rotations that depict or they don't have a lot of power behind them. You know, the DJP and GSG, they've got long tails. There's a lot of power behind that move. Big rotation, and it's now a powerful corrective move. If you look at ITOT, that's actually a short tail. The good thing is that it is picking up. It's picking up on relative momentum, but it's still losing relative strength, going still lower on the JDK-RS ratio scale. So it's a bit in limbo. Same for government bonds. You know, they're picking up in relative strength, but they're losing relative momentum. If you look at the daily, then there obviously is a clear preference for stocks, and whereas GOV is right here going in the opposite direction. It's a bit messy, I guess. We'll take a look at sectors later on and see if we can get a better handle on stock market performance. But long-term preference for stocks over bonds. Short-term, well, the daily suggests that we should have a preference for stocks, but it's a very short tail. There's not a lot of power behind this move either. And as you've followed my shows and my blogs recently, I'm still not 100% convinced that this bull market is going to power on as we have seen over the last months in the next few weeks. I do believe that we're in a long-term uptrend, but I also do believe that we need a little bit more of a correction. Now, last week was an interesting week, and we had a very interesting weekend, I guess, and I'm watching my quote screen here on the left. It's Monday evening for me, daytime for you guys in the US, market's still open. And obviously the events that we saw in Afghanistan unfolding at the end of last week and over the weekend, markets were kind of nervous, and that's what we saw in Europe and Asia, where markets were lower. US opened lower, but right now they're actually higher again. So I'm kind of wondering, what does this market need to actually see a correction? In other words, this is also a sign of strength. If even this kind of events cannot push this market down and urge people to sell, then what is needed? And that is a little bit confusing, I guess, and something that, it's probably a big word to say it worries me, but it sort of it definitely confuses. And I had this analogy in my head for a couple of days, and I didn't know how to explain it to you, because there's this Dutch-Belgium comic series, and in Dutch it's called Suske and Wiske. And I actually had to look it up, whether there was an American version of that comic, and there has been a translation. And in American and in English it's called Willy and Wanda. And if you know the comic, if you know that comic series, then you know that the Willy and Wanda have a friend called Jerome. And Jerome is a bodybuilder type, very strong guy, blah, 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 blah. And the funny thing with Jerome is always that when he hits someone or something, it's like, you know, a comic has these little images. They go from image to image to image. And Jerome always, you know, he hits a person or he hits something, and in one image he hits it, and then in the next image nothing happens, and then Jerome says, oh, he still doesn't know he got hit, and then like 3 images later you see the guy falling over or you see the thing falling apart. And that's what that image keeps coming back when I look at this market. It's like it's got hit by Jerome, just doesn't realize yet that it was hit. And we need a few more images in that comic before it actually starts to turn down. I hope it makes sense, I don't know, but I thought it was quite funny, and it's something that's in my head. This market, there's so much going on, and there's so much confusion, there's so much things that are unclear, that I just don't feel comfortable being 100% long stocks. Does that make sense? I hope so. Anyway, that's it for this. And there's one chart that I want to share with you in the asset classes, because we've seen all these charts and you can look them up. But the one that keeps me ahead and keeps me awake is the relationship between stocks and bonds. And as you can see, we had this very nice uptrending channel. Then we started to move sideways and sort of break it. Now we're kind of breaking out of that range again. And remember that last thing here. This is the start of this week, and earlier in the day, the close was right on top of that support level, that dotted line, and it's now picking up again, obviously, because the market has gone up so far. But the divergence between the RSI and that ratio is still very clearly visible. And it's still there. It's kind of struggling here on the weekly S&P. We've got that here. Got that divergence. It's getting less and less and less. I've got to admit that. I mean, if you zoom in here on that chart, then you will see that it's not breaking out yet, but it's not as strong anymore as it used to be. But we are still at overbought conditions for a long time. Confusing to say the least, and that's what's keeping me awake. That's what's keeping me alert on things that might happen. Again, the long-term picture is pretty clear. It is, will we see a more corrective move going forward that gives us possible new entry levels to profit from ongoing sector rotation? I think that's the best way I can describe this whole thing. When we jump over to sectors and look at the daily rotation here on the left-hand side, that includes today's rotation. So let me make this 6 days, then we have 1 week plus today. So this is live. And we can see that actually it's kind of spread out. Very often you see rotations and sector rotation move. You see similar sectors moving in similar directions. So defensives move with defensive, offensives move with offensive, like the whole offensive defensive thing. You usually see that very, very clearly on the RRGs. What we see now is that there are conflicting rotations among offensive and defensive sectors. So there's not a very clear trend to offense, nor is there a very clear trend towards defense. If you look at the daily rotation here on the left-hand side, you see staples and utilities moving in line together as defensive sectors, probably representing the sort of uncertainty that creeped into the market towards the end of last week. But healthcare still okay, not fantastic. Communication services, that role changed a little bit. We saw technology, that's sort of it does whatever it wants. We had a time where technology was the new defense. Then when technology came under pressure, it moved together with the offensive sectors when it started to lose relative strength. It's kind of unclear. And if we look at what happens on the weeklies, then it's probably even more unclear. The biggest discrepancy that I see here on the weekly is between utilities and staples. Because you see utilities actually picking up. We moved from improving back to lagging and now back into improving. But if you look at utilities, and usually utilities are, when you look at staples, and usually utilities and staples are moving along, this is going completely the opposite direction. So you see staples continue to move into lagging while utilities is moving out of it. So this is like very unclear, very confusing type of rotations. Then look at healthcare, which is actually looking very, very strong. It's a confusion picture, to say the least. If we have a quick look at the rotations, then as I said, defensive, staples, utilities, pretty good week last week. Materials, nicely on top together with industrials. Then we have healthcare, which last week we labeled as the defensive sector. You watch healthcare for defense. That is working out fine. SPY did 90 basis points. Financials picked up nicely. Last couple of days started to roll over, but nevertheless a pretty good move. And then we had communication services, technology, real estate, discretionary, energy, all moving lower. And you see energy here already starting to roll over inside the improving quadrant and very likely rotating back down towards the lagging quadrant. If we put that onto the weekly RRG, then technology, that's now moving due east, like 90-degree heading, RRG heading 90 degrees, which is due east, which is good because it's picking up relative strength. That's a good thing. There's no increasing momentum anymore behind the move. Healthcare is doing good, still at a positive heading, slightly below, what will that be? 80, 85, maybe 75. Nevertheless, it's good. It's still picking up on both scales. Consumer discretionary, XLY, still picking up on both scales. And utilities at a positive heading, although it is one of the weakest sectors. When you compare utilities with materials and energy, then clearly utilities is the better sector. What I noticed on this weekly RRG is that there are actually only 3 sectors that are giving us a positive RRG heading. And those are utilities, as I already mentioned. It is healthcare that we see there. And it is consumer discretionary, inside improving. And then technology is sort of on the edge. It's like it's 90 degrees. So well, okay, maybe 4 if we include technology. But that means that the other sectors are all at a negative heading, almost, well, they're all at a negative heading. Look at them. The only one here, financials, is maybe just like technology. It's like it's and materials. They're moving due west at 270 degrees. Nevertheless, they're all losing relative strength versus the benchmark. That's kind of weird. And an alert, a warning signal. Now, in last weekend's newsletter, in the ChartWatchers Newsletter, I wrote an article, and the title was Sectors to Groups to Stocks to Find One Dominating Stock, Dominating Name. And let me find that article for you right here. From sectors to groups to stocks to find one name that dominates. And what this article actually does, and I try when I write for the newsletter, because that goes out to a lot more people than just the RRG blog, I try to include ways of how you can use RRG in a different way or repeat, and give a little bit more background on how you can use it. It came out as quite a long article with a lot of images, but it's a step-by-step approach on how you can use RRG and the StockCharts platform to drill down from sectors to groups to individual stocks and make up your mind, build it into a process. Got a ton of replies, got a ton of feedback how much people love that article. And that's a good thing because I love the interaction, but I would never have thought that an article like this would gain so much traction. That is something that is apparently really appreciated by people. So I don't think I can do it every 2 weeks in a newsletter article like this, but I will definitely, when something pops up in my mind, put that into writing. However, the whole process lends itself much better to show live online while I work with the platform. So what I'm going to do is I'm going to take the information that I just talked to you about, what we saw here on that weekly RRG, where I've identified pretty much only 3 sectors that are showing a positive heading, and dive into those sectors and see if we can do something in terms of individual stocks and how you can do that on the platform. So in order to do that, I've got to go back to the platform, because here's the sector RRG. So that's the starting point. That's where we find our sectors that we want to dive into. So we want to dive into utilities, discretionary, and healthcare. That's what we want to do. In your dashboard, you will find, or you can find, a sector summary page. I put it as a widget here on my home page. But if you go to the sector summary page, you will find all sectors with a ton of information on each line. So you can get the symbol summary, you can get a chart, a sharp chart, you can go to ACP, you can go to point of figure, a lot of stuff. And here are icons that show you grouping things. So you can look at a market carpet, you can look at a perf chart where it compares all the groups, and you can run an RRG. Now, if you click that RRG icon on one of these sectors, what it will actually do is open up an RRG for the industries, for the groups that make up that sector. So it's the next level of the breakdown. And it will open it up with the S&P as the default benchmark. So what we're looking at here is the healthcare sector broken down into groups. Now, very clearly there is, and this is to be expected, because this sector is already doing good versus the S&P, so you would expect the majority to be in the leading quadrant as they're outperforming the S&P. Very clearly, there's one sector or one group that stands out, and that's healthcare providers. So within the whole sector, we can sort of immediately put aside the healthcare providers, as they are not tagging along with the rest of these industry groups in that healthcare sector. Now, this is with the S&P as the benchmark. If I change that to XLV, which is the sector index, and update it, you see a change. You see that it's all changing, and the reason is because the healthcare sector itself is also moving. If I quickly go back to that previous one, you can see healthcare here. So the benchmark is here. But when you walk through history, you can see that the interaction, that the relative positioning of the various groups versus the sector index is constantly changing. So this is it's like a moving target, if you want. Now, in the next step, what I did is I put XLV in the middle. So I took away the relationship with the S&P 500. I now put these groups against the healthcare sector. And now the healthcare sector, so XLV is the center of the chart. What I then usually do is I tick it off, because I don't need that. I know that it is the center of the chart, so I don't need it. And now you can have a look at all these individual groups, and you can find the group that's actually even better than the sector as such. And as you can see, that has now changed a little bit. So if you go through it, clearly the providers index is still a no-go area. But what you can see is that the medical equipment group apparently is one of the strongest, or the strongest group in this universe of healthcare groups. If we go past all of them, you see biotechnology, pretty good, but rolling over now. And this is medical supplies, picking up nicely. That's pretty good. You see medical equipment, we already looked at that. And you see pharmaceuticals, which is interesting because it is at a stable trend and it's picking up relative strength. It's not increasing in momentum, but it is still moving higher on the RS ratio axis. So now I have identified my groups and stuff. Now I've already written an article about medical equipment not too long ago. So what I want to do now is dive into pharmaceuticals. In order to get to the individual members, to the stocks that make up that pharmaceuticals group, I need to go to the scan engine, to the scan functionality. And if I create a new scan, then it opens up like this. I want to take away the default line. And what I do is I go to the bottom of the scan components where I can choose industries and sectors. And I go to the healthcare sector, which is down here, and choose the pharmaceuticals group. And then I say add. And what you will see is that the scan engine has added the line that I need to select all the pharmaceutical stuff. Then I run this scan, and you can see that it gives me 300 matching stocks. These are all the stocks in the database that are classified as a pharmaceutical stock. Now this is way too long to put on an RRG. So I'm going to limit this to stocks that are also in the S&P 500. I go back to the scan engine, I go back to the components, and I choose that the stock also has to be an S&P 500 stock. I click add again. I get two lines, so it needs to be in the pharmaceutical and it needs to be inside the S&P 500. If I run the scan again, I now am left with 14 names. That's a more manageable number. The next thing I do is I save this group. I store these results in a new chart list. And what I do, I give it a name. And I've learned myself to do XLV, which is the sector, and then say for pharmaceuticals. Okay? And now I have a chart list with all the pharmaceutical stocks that are also inside the S&P 500. And the next thing that you can do here, and that's very nice, you can view the list not only as a summary, but also as an RRG. That will open up my pharmaceutical stocks as an RRG with the benchmark S&P 500. And now we can play around. So instead of the S&P 500, I can change it to XLV, just like I did with the groups. And now I get all these names versus XLV. But because we are now inside an industry group, and you can see here the sector is healthcare, the industry is pharmaceuticals, I can now also put this against the industry index. And in this case, that's $DJ USPR. So $DJ USPR. And now I have all the members versus the pharmaceuticals index. So you saw that it didn't move around a lot. And that's because the healthcare sector itself is very close to the S&P 500. And the pharmaceuticals index is also very close to XLV. Sometimes this can make a massive difference. What I can do now is I can look for individual stocks and browse through this universe and find a very interesting pharmaceutical stock that I maybe want to explore a little bit further, dive into. So here Pfizer seems to be picking up again. Might be worth another look. CTLT. Let's bring up these stocks here. So PFE, this is all against SPY. Seems to have run along, I wouldn't get into this. If I look at CTLT, then that could be an interesting stock to look at when it breaks higher. And I can go through all these individual names and see if there is anything that I think is worthwhile pursuing. I've got to wrap it up here as we're running out of time. I could talk a lot more about this stuff, which we will do in new episodes of Sector Spotlight. Ladies and gentlemen, thank you for watching. This was Sector Spotlight for this week. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, and I'm looking forward to seeing you again next week, same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.